After almost 30 years of near zero interest rates and a mostly quiet government bond market, Japan's bond yields are finally moving again. And when they move, the headlines swing wildly. One day it's bond disaster, and the next day it's bond rebound. Let's take a step back from the day-to-day drama and explain what just happened. I'm Richard Vague with Tycos. To understand this, we need three background facts because the bond market is reacting conditions that have been building for years, if not decades, not just a single news cycle. Fact number one, for nearly this 3-decade period, Japan faced weak private borrowing demand. Private debt peaked at over 200% of GDP in the late 1990s, thanks to reckless overlending in the 80s and early 90s. And since then, steadily declined to 151% by 2015. That was incredible deleveraging that sapped the lifeblood out of growth. Folks talk about the lost decade or the lost decades. That was the issue. The private sector had gotten way too leveraged and was deleveraging. Private debt as a catalyst of economic growth had ground to a halt, resulting in Japan's share of global GDP falling from 18% to just a mere 3.6% during this period. Imagine that. Recall that we thought Japan, which had nudged into being the second largest economy in the world, is now only 3.6%. More recently, Japan's private lending has come back to life. Private debt to GDP climbed from 2015 to 2020, rising to 180%, and it has hovered in the 175% range since then. If we look at debt nominally, private debt is on the rise and is finally back to the levels of the late 1990s. The big picture here is that the multi-decade deleveraging story helped explain why Japan had moribund interest rates for so long. And the more recent turn helps explain why those rates are now percolating back to life. Japan's government debt often makes headlines because of its extreme gross debt to GDP ratio of 235%, compared to the U.S.'s 122%. But gross debt is only half the story, which leads us to fact number two. Japan holds significant assets. Japan's treasury, its government, actually holds stocks and bonds. But when we net those out, its debt burden is much lower at 134% of GDP. Think of it this way. If you have $100,000 in debt with no assets, then you have $100,000 in net debt. But if you own $25,000 in, so let's say, treasuries, your debt of $100,000 is net debt of only $75,000. The takeaway here is that assessing debt levels and risk requires looking at the net, not just the gross debt level. And by the way, contrast that to the U.S., where the government owns almost no public securities or debt. Well, all that brings us to fact number three, which is the simplest and in some ways the most important for understanding why yields are moving. Japan has been the global interest rate outlier for decades, but it cannot plausibly remain far below its peers forever, especially if inflation is no longer near zero. For example, if Japan's 10-year yield moves from something like 1.8 to 2.0% and inflation is running near 2%, then the implied real rate is still roughly zero. Again, the story isn't, quote, those yields are high, end quote. The story is, with the long stretch of deleveraging over, Japan's rates are behaving less like a permanent exception, a permanent outlier, and reapproaching a rate profile similar to their developed country peers. The current rate on the U.S., German, French, and U.K. 10-year bonds are 4.05%, 2.72%, 3.27%, and 4.50% respectively. Japan's is 2.15%. It's not hard to imagine that Japan's rates will approach those other numbers over time. So when you see the headlines, bond disaster and then bond rebound, here's the center line to remember. This isn't just noise. It's a market repricing because the conditions that supported ultra-low rates for decades, especially the long private sector deleveraging and Japan's outlier status, have changed and are continuing to change. That's all for this week. Thanks.